as well. I think about the Tesla example and the run-up in 2020. Retail investors piled into that because they are kind of at the heart of this bull thesis. Rivian's priced at what now? $147 a share. How much of this is the retail investor buying in with FOMO, right? Remember, lots of retail investors got left on the sidelines with some of these stocks, not just Tesla, others as well in the great pandemic run-up, because it was priced too highly, and that resulted in stock splits.
Which is going to be interesting to see if we do see stock splits, because they're basically what your thesis is. Therefore, they're trying to get in before you have to have the stock splits to gain access.
Right.
So you basically you want to buy now.
In the case of Rivian and Lucid, etc., buy now in case it runs away. Right.
Yeah, I definitely.
In terms.
Sorry, go ahead, guys.
Sorry, Alex. No, you had a definite in there, so let's go with the definite.
Yeah, because we always trust my definite. It's definitely something that we're definitely going to want to do. I was going to say, I have friends calling me asking about Rivian. I feel like if that doesn't say something, I don't know what does. And this was after it IPO'd. I did want to talk about, though, so that's like the animal spirits in the market, and I'm just wondering how that then pairs with the actual fundamentals. And I'm taking a look at, TJX, the top performer within the S&P. Right. Then you have, Target weighing quite heavily, even though numbers were good, outlook is good, and in some weird way, fundamentals do matter, particularly the little stuff like margins for companies, just not when it comes to Tesla and Lucid.
Absolutely. Going into this earnings season, it felt like we kind of abandoned the comparison with the same period a year ago, which is worth doing. It's worth comparing with that period where the pandemic was at its height, and in a year before that, in 2019, pre-pandemic levels, when it comes to e-commerce and the retailers, right? I bring that up because we look at the pain in Walmart stock under concerns about margins. Remember, Wall Street and investors were prepared to absorbed that pain a year ago when Amazon was committing $4 to $6 billion to survive the pandemic, to adjust its business model so that it could buy into those sales volumes. It wanted to keep its customer base. Now, the threshold has moved and investors don't have the same pain tolerance, Alex.
I think the biggest kind of story in all of this for me is the fact that the Staples Stadium, which I've never visited, maybe you have.
Formerly Staples Stadium.
Formerly?
It's a report, for sure, yeah.
So I imagine if we all want to go and see the Lakers, then we've got to pay in crypto.
And the Clippers. You're going to upset a lot of Clippers fans. The Lakers and the Clippers play.
Oh, right, sorry. Yeah. As I said, I'd never been there before.
Sports.
Yes.
Alex's favorite subject.
I am reminded that, back in the day, you had Enron Field in Houston. I'm also reminded that the Super Bowl I went to in 2005, the halftime show, sponsored by Ameriquest Mortgage, those companies don't exist anymore. So who knows what this Crypto.com arena really signifies.
I think you make a perfectly valid point, Dave, and I think the lessons from history are well worth remembering at this point. It never repeats itself, occasionally rhymes. Dave Wilson, Ed Ludlow, great stuff. Thank you very much indeed. We're not done with this conversation yet, because coming up next, Mike Wilson, Morgan Stanley's chief US equity strategist, will be joining us. This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
what did he say about me? What did that particular gentleman say about Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
From New York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
I think that the way we've been looking at value traditionally on, the simple price to book, simple price to earnings is not the way I see value as an investable thesis going forward.
Don't get too comfortable in the fast lane. Stay invested, resist the temptation to take a bunch of profits.
Point is, there's still a way to make money in this market.
Some of those bears that we've heard from over the past few months saying that they're waiting to buy the dip, they're not waiting anymore.
There are a couple of things that really supporting a still positive view on equities.
There's kind of still a period where equities continue to outperform.
Don't take money off the table. Stocks are still the most interesting investment and perhaps the one that will offer the best returns, not just in the fourth quarter, but into 2022.
And I just simply don't see the case for a growth scare. I don't see the case for the idea that we're going to be flirting with recession, which is typically what really pushes us down into negative territory in equities.
Those are some of our markets guests over the last week on how they're investing for 2022. Joining us now, Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist. Morgan Stanley's 2022 year-end base case is for the S&P at 4,400, down 5% from current levels. I do feel like you're an outlier at this point. Give me your base case here. Explain.
Yeah, I mean, it's really just unexciting. I mean, the range. So we have, we obviously look at a bull bear case because markets trade in a range, and so for next 12 months, it's 3,900 on the downside, 5,000 on the upside. So we do have upside scenario, and I would say, Alex, that in the next 12 months we might hit both sides of that. I think that there's going to be there already is a lot of uncertainty with this economic environment. Okay, companies are struggling with the supply chains. Some are doing really well. Some are not doing so well. Some stocks are reacting in kind of weird ways into that. I really enjoyed listening to your last segment around kind of all these other things that are sort of happening around the edges that's creating speculative behavior. And look, it's been a difficult environment, I would say, for the average active investor for the last 2 or 3 months. Our clients are not. It hasn't been an easy pitch. Like there's been small caps leading 1 week, and then it's growth stocks, then it's value, then it's growth. It's all over the place. And to me, that's the market telling us that that the next year is going to continue to be very uncertain and volatile in terms of the economic outcomes, whether it's inflation, whether it's growth, and what actually happens, how the consumer kind of stays in the game. So the story for 2023, Alex, the punchline is there's still plenty of investment opportunities, but it's much more at the stock level now than it is at the index level. And so we're focused on that. We actually do publish a focus list. We've had good success with that. I think calling sectors and I think calling styles is going to be much more inconsistent than it has been over the last couple of years. And the reason why is because we're going through a massive structural change that we've been writing about for a while, this sort of shift from monetary policy dominance to fiscal policy dominance, higher nominal GDP, higher inflation. And that's just a much more volatile outcome where execution becomes key for companies and stocks.
Mike, as you look into that environment that you're describing for next year, the bottom-up rather than top-down environment that we are going into, do you think professional investors, stock pickers, have got a handle on what is happening here? Or do you think retail is going to do? Do you think retail will continue to outperform? Do you think retail is actually in a better position at this stage to be picking what is happening because they can see the trends and they're latching onto them?
It's a really good question. I would say this year, the retail investor has had probably better success because it becomes self-fulfilling. As you guys were just describing, it's a momentum game. And these chat boards and these rooms give them a vehicle by which to use to drive certain investments higher or lower to their choosing. And they're putting money behind it. And that has actually wreaked havoc with a lot of institutional investor portfolios, as you know. We now have one of the lowest short bases in history, at the single stock level, specifically because of that phenomena you just described, Short sellers getting run over on single stocks. And that, I think, could persist. I think, until the retail investor really pulls their horns in, which doesn't look like they're willing to do that yet, that's just something that we're going to have to deal with as investors. All investors are going to have to deal with that big player now that is moving stock prices around aggressively.
So talking about that, and this sort of pivots back to our earlier conversation about, say, Rivian and Ford, for example, is you had written in your note for 2022 that we think the obsession with growth versus value will start to die. You recently just mentioned that, too. Idiosyncratic risk becomes the key. You do have a slight bias, though, towards value because of its higher leverage to rising interest rates. And you guys do see a 10-year yield over 2% in 2022. Does that wind up hurting growth? Like, is that Fed-based? How do we get to 2%?
Yeah. Well, we better hope we get to 2%, Alex, because that means if we don't get to 2%, I think everybody's economic forecasts are going to be wrong for next year, right? The terminal rate is just mispriced for if people really believe their forecasts for growth. I mean, we have a 8% nominal GDP growth forecast for next year. I mean, a 210 10-year by the end of next year doesn't seem, very generous. I mean, I would say that's probably, it could be higher. If anything, it could be, positively biased. So, at the end of the day, the growth to value thing, I think, has been an obsession because it's been either one way or the other, right? In the recovery we saw, from the tech bubble bursting to 2010, it was value stocks. In this recovery up until the COVID recession, it was all growth. And then last year, it was both. Value had a really good 4 or 5 months, first part of the year, and then growth had a really good second half of the year. We were fortunate. We caught both sides of that, and that's what we're going to be doing now. So we have a slight bias to value right now because we think rates are moving up, but we could change that very quickly, in the next 3 months. And I think that's the messaging I want to leave with people. Don't get married to one style here. It's not going to be that kind of an environment anymore. You need to be more flexible and not focus so much on these style and factors. It's about, can this particular company that I own execute in what is a very difficult environment and capture the nominal GDP, which is going to be quite good?
Mike, let's just wrap it up. You said you enjoyed our last segment. Let's get your take on it. You were around in 97, 98, 99. Do you feel any echoes from that?
Yeah, I'm one of the really old guys. So, it's funny you were talking about those chat boards in the 90s. I remember them vividly. I mean, it was really interesting. It was, and I would agree with your statement completely. Today, so let's just compare that real quickly. You had chat boards that people would have to dial up on a modem at night, to kind of participate in these things. Now it's 24/7, on a phone, and you can do it all the time. So it's just much bigger. Okay, like this whole phenomena of day traders at home, and now they have more money too. And so that's the biggest similarity that I see. And I absolutely think there is some extraordinary valuations out there that are unsustainable. And it's very similar in that regard. Whether or not we're going to have I don't think there's a bust on the other side necessarily where spending is going to disappoint like we had, post the 90s sort of tech spend. But I do think there are going to be some eye-popping declines in some of these stock prices over the course of the next 12 to 24 months. Because they're not justifiable. I mean, they're just not. And I think a lot of the folks who are participating in this will be hurt. But one thing I would say that's different this time is how relentless this crowd continues to come back. Right? We've had multiple drawdowns this year, yet they continue to participate, and that tells me it's more sustainable. It's not going away.
I miss the sound of those modems. Mike, thank you very much indeed. Really appreciate it. Mike Wilson of Morgan Stanley. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris, we talked about this, we talked of other things. Now that's moving to become mandatory.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Live from New York, I'm Alex here with Guy Johnson over in London. This is Bloomberg Markets. All right, we're nearly an hour into the trading day right here in the U.S. Stocks trading a little bit heavy. You could blame some macro data for that. We had home construction in the U.S. unexpectedly slowing down. Again, it's the whole there's not enough supply to meet that kind of demand. And you have Target really weighing on the S&P after the margin outlook disappointed there. On the flip side, though, you got to look at TJX. Super solid numbers. Home goods store up over 30%. That really outperforming and helping to lift the consumer discretionary sector within the S&P. But overall, it feels a little bit heavy here on this Wednesday as we going in to a day of a ton of Fed speak. Also, we're watching a lot from Washington right now as well. Powell or Brainerd? Will he or won't he? When will he pick? We'll discuss. This is Bloomberg.
We landed with 40% remaining. Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels. So there you go. There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
Is doing exceptionally well. So let's talk about the paid users for a moment. Our strategy has been to create value-added experiences that our users want to pay for, that adds value to their experience.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
So live from London, I'm Guy Johnson. Alex Steele is over in New York, and this is Bloomberg Markets. Alex, let's talk about retail earnings, fee charges, and Alzheimer's drug controversies continuing to lead today's market movers. There's a Biogen story, there's a day two retail story. Kriti Gupta was covering it all.
Well, Guy, so many stories on the individual based on a micro basis. Let's start with healthcare here, because Biogen under some pressure after facing some doubts on its Alzheimer's drug from the EU Medical Authority. So you are seeing those shares down. No formal decision yet, but it is coming soon. You also have Cassava Sciences down a whopping 24%. This after the Dow Jones reported they may be the target of an SEC investigation that alleges data manipulation for their own Alzheimer's trial. You also had to the upside, though, Eli Lilly seen as a beneficiary for, once again, the buzzword, its own Alzheimer's drug. I want to take a look, though, at some of those retailer earnings, because that's what the upside drivers in the S&P 500 are really. Lowe's, the parent company of TJ Maxx. It's that same diversion that you saw yesterday between Home Depot and Walmart. Essentially, consumer discretionary, disposable income still coming out strong, which is where you saw Lowe's lift their fiscal outlook in addition to strong revenue. Same story here with the parent company of TJ Maxx. In addition to queuing up a pretty strong holiday quarter. To the downside, though, you do have Target, which, despite a fairly strong revenue, did actually talk about margin pressure, similar to what we heard from Walmart yesterday. Supply chain costs, labor chain costs, that's what's weighing on the stock. And I want to end here with the two biggest weights on the S&P 500, and those are those credit card companies, Visa and MasterCard, after a story that Amazon is actually going to ban Visa credit cards from its payment platform over in the UK. This idea that those Brexit kind of negotiations have basically resulted in higher fees for the UK, not subject to the caps over in the EU. And for that reason, Amazon is actually being forced to pay even more. And now they're saying, we just don't want to do it. So you do see those shares down intraday, but also weighing on the S&P 500 as a whole.
Yeah, really interesting. We're going to definitely delve into that in the next hour. Thanks so much, Kriti Gupta, joining us from Bloomberg. We're about an hour into the trading session in the U.S. Now, that's sort of what's happening on a day-to-day basis. Overall, we're still really waiting on tenterhooks as to what President Biden is going to do as he's mulling over his pick for the head of the Federal Reserve. Bloomberg's Michael McKee and Anne-Marie Hordern with us now. Hey, Anne-Marie, we got the news yesterday that it was going to be like 4 days from yesterday. What is the timing? I don't get it.
Yeah, imminent to indecisiveness. The president is still deciding whether or not he's going to reappoint Chair Jay Powell or potentially elevate Governor Brainard. And he said, by the grace of God or the goodwill of God and neighbors, you'll know in about 4 days. So just quickly on the timeline, 4 days, if you counted yesterday as the first day, that would be Friday when they're going to have that big White House ceremony when they pardon the turkey, or Saturday. But Saturday is the president's 79th birthday. I don't see him announcing the Fed chair then. So potentially early next week, but we will have a decision before Thanksgiving. And the White House is obviously also seeing to make sure they have the votes in the Senate. And Senator Brown says that by and large, broadly, the Democratic Party will support either of the president's choices. So we're just waiting on the announcement because the market, for the most part, thinks whether it's Powell or Brainard, monetary policy is going to remain the same.
I wonder what the president is asking for his birthday this year. Better approval ratings could certainly be on the list.
Lower inflation.
Yeah, inflation coming down. Well, that's kind of perfect, Anne-Marie, because that kind of takes me to Mike. What do you think, what is separating these two? Why is this decision taking so long, and why does it appear to be so hard? I'm really struggling with this because they seem to be actually pretty much on the same page, Brainard and Powell, when it comes to what needs to happen next with monetary policy. So why is this such a tough choice?
It's been a little bit of a divisive choice within the Democratic Party because Brainard is seen as more liberal. She is a registered Democrat. She may be more anxious to involve the Fed in social issues like climate change. All this at the margin. But when you're trying to get through the Build Back Better and infrastructure plans and you have 3 votes in the House and you have a tie in the Senate, you don't want to offend anybody. And I think that's what really slowed Joe Biden down. Now he's pretty much got to make a pick because they'll run out of time, even though they haven't finished the Build Back Better plan.
So literally, if all of a sudden we get a headline that crosses that said Lyle Brainard picked his head as the head of the Fed, what happens to the market? Like, where's the reaction?
You might get a knee-jerk reaction. I wouldn't worry about the first 5 minutes, but in general, there's
like buying bonds, like buying the long end,
going to be a whole lot of reaction. What you might see is some reaction in bank stocks if there's an extrapolation that she's going to be a tougher regulator than the current chairman, but policy isn't going to change. Right now, the pressure is on to raise rates, to tighten policy because of inflation. So even if Brainard is nominally more dovish, she's not going to be in this situation.
Anne-Marie, is there a vote issue here? Is there a vote count problem that they're trying to figure out as well? Like, they've got to clear the Senate. Is there going to be a problem there?
According to Senator Brown, he doesn't see there being a problem. He's really going to be the first offense. But there are, I would say, individual senators who take issue with both. I wouldn't just say it's either or. One would be, of course, Senator Elizabeth Warren. We heard what she said directly to Chair Powell, saying he's a, quote, dangerous man. Then there's other, like Senator Whitehouse from Rhode Island, who thinks that if Powell is going to be reappointed, he wants to hear a little bit more of a tougher talk, or how the Fed is going to implement potential climate change provisions. Then you have some Republicans who do want to stick with Powell. But at the same time, again, it's the fact that they are pretty much in lockstep when it comes to monetary policy. They're going to have enough votes to get this through. I would say there's one individual to look out for, and this is Senator Joe Manchin of West Virginia. He's going to be having a meeting with Chair Powell. Now, in August, Manchin had written a letter to Chairman Powell talking about his worries about inflation, saying that he's done a great job guiding us out of the pandemic, but you don't want to oversubscribe the patient. This is what Senator Manchin had to say, and potentially he's going to ask Jay Powell on what he thinks comes next, given inflation is running with a 6% handle now.
One other complication that may factor into all of this is that there are 3 open seats, 2 not officially open yet, but by January they will be, the 2 vice chairs, Rich Clarida and Randall Quarles, and there is an open seat. And so for the Biden administration, if they want to take advantage of all this and fill all these seats at once, there's a chess game going on of whom do you appoint. Jay Powell, the Republican, was packaged with a Democrat in 2016 when he came to the board. So at this point, it's kind of hard to see how they would be able to appoint 4 Democrats and get the Republicans to support them. So that's a reason maybe Powell stays as the token Republican, and then they fill the board with other Democrats. But that's something you have to consider as well.
Bloomberg's Mike McKee, Anne-Marie Hodurin. Guys, thanks a lot. Really appreciate it. I feel like we're counting down. Big countdown clock. Okay, let's get to oil inventory numbers, because this feeds into the whole inflation conversation. So you did see the first build in Cushing in quite a long time, up by 216,000 barrels. But you saw a pretty solid draw, bigger than expected. You also saw a draw in gasoline inventories, a draw in distillate inventories. Refinery utilization picked up a lot, and implied demand for everything also picked up. So, Guy, it still feels like we're drawing oil, we're refining it, and we're using it as fast as we can get it out the door. And this kind of pairs with what we just heard from President Biden just about 15 minutes ago, apparently asking the Federal Trade Commission to probe possible criminal conduct in the U.S. gasoline market. That raises some suspicion here about some differences between pump prices and the cost of wholesale fuel. All that inflation, that's all about that inflation, getting what you're paying out of your pocket down.
Yeah, it feels like they're reaching for every lever available at the moment.
A little bit.
Some of this stuff could backfire. I don't know. It's a real struggle. And there seems to be some fairly simple ways that the president maybe could alleviate the issue at the gas pump. I'm not sure maybe going down this route is going to be the easiest way of making that happen. Anyway, he's got some challenges. Maybe he'll get some opportunities for his birthday. Coming up, supply chain costs hitting retail margins. That's the story today. You can really see the difference between the companies that are struggling and those that aren't. Elias Sabo, Cody and CEO, is going to be joining us next to talk about that. We'll figure out what's happening out there. The supply chain story absolutely front and center. This is Bloomberg.
common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. China is speeding up plans to replace American and foreign technology. Bloomberg's learned that a secretive government-backed organization is certifying local suppliers in sensitive areas from cloud computing to semiconductors. Roughly 1,800 Chinese makers of chips, PCs, networking equipment, and software have been approved. Meanwhile, U.S. Commerce Secretary Gina Raimondo wants China to follow through on their pledges to buy more American products. We spoke to Raimondo at the Bloomberg New Economy Forum in Singapore.
China needs to play by the rules. They need to respect our IP. They need to live up to their commitments. You know, right now, for example, in the so-called Phase 1 deal, where the Chinese committed to purchase a certain amount of, aircraft and agricultural products, they're not doing that. They're not living up to their commitments.
Raimondo also said there needs to be greater transparency in the semiconductor supply chain. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Guy.
Rika, thank you very much indeed. Let's get back to the retail story and talk more about it. Target taking a little bit of a tumble today. It feels familiar because we got the similar story yesterday from Walmart, I think. Basically, it's warning that cost pressures are starting to escalate. The CFO was talking to John Ferro a little bit earlier on. This is what he had to say on this very matter.
I wouldn't use the word easy, and that our teams have, like they have for the last couple of years, been navigating a lot of challenges. But I feel really confident in the output of that incredible work. You can see on our balance sheet, inventories are up over $2 billion to last year, almost 20% to a year ago. And that tells me we're well positioned to support a strong holiday season.
Mike Fidelki talking about what Target's seeing right now. It's a similar picture in many retailers right now, so we need to focus on it. Let's get some more insight. Joe Feldman, Telsey Advisors Group Senior Managing Director. He's got an outperform rating on the stock. He's got a 305 price target. What do we make of the numbers? What do we make of the market reaction? The market seems to be punishing any misstep when it comes to managing the supply chain.
Yeah, I've been surprised to see that Walmart and Target have sold off as hard as they have. I think that people have been frustrated that they were not able to drop more of the strong sales to the bottom line. And as you said, it's the supply chain pressure, and that's all encompassing. It's everything from the labor to the delivery of the goods and how you get it here and processing the goods. So I think that the real issue here is they're gaining market share. Target's gaining market share. Walmart's gaining market share. Their sales are growing at a much higher level than we had all expected. And yes, there is supply chain pressure. We know that. We knew it coming in. And yet they've held their own, and they've been able to see earnings increase as a result of the stronger sales.
Yeah, Joe, that's so interesting because it begs the question, kind of, why was this a surprise then in terms of supply chain issues in relation to the stock decline? But I also wonder, who are they taking market share from, and like how much market share do they need to take to kind of offset these shorter term issues?
Well, I think they're taking market share from, there's a lot of smaller players. There's a lot of players that left the industry, that just went bankrupt over the past couple of years because of the pandemic. And so there's been a lot of share to grab there. But they're doing a really good job fighting it out among the other discounters, among the grocers, and, they are winning. Now, you could argue that the supply chain side of things, I would argue that they're actually winning there too. Look at the inventory growth that you've seen at Walmart and Target, and year over year, it's up really significantly. They are well positioned for the holiday season. They're going to have product as others may run lean. I think that Walmart and Target will actually have a much better supply chain through the season.
What is your expectation for how long this supply chain story is going to last for? When does it start to even out? When do the bottlenecks start to go away?
Our view at Telsey Advisory Group is that it's going to be well into next year. It could be middle of next year before things really start to ease. I know there's talk today about, things may be peaking, and that may be true. Even if the supply chain pressures are peaking now or through the fourth quarter, it's going to still take well into next year for things to get back to a so-called normal. I think that, this pressure doesn't just unwind immediately. I think there's a few players that really own a large portion of the supply chain. So we're thinking it's really second half of next year before things start to see some easing pressure on the retailers.
Hey, Joe, thanks a lot. Really appreciate it. I know you got to run. It's been a busy day for you. Joe Feldman, Telsey Advisory Group, a Senior Managing Director. Thanks very much. All right, let's stick to retail. Joining us now, Elias Sabo, Coty CEO. Coty invests in middle market companies across consumer and industrial sectors. And today we're going to focus on the consumer part of it. Elias, it's always good to see you. For your consumer businesses, where do you take the hit? Like, do you not have the goods because of the supply chain, or do you take the margin hit?
Yeah, good morning, Alex and Guy, and thanks for having me back on. So, for us, supply chain has been one of the biggest issues that we've been dealing with. As I've said a couple of times, on prior appearances, our demand is really robust. We have found that we have an ability to push through pricing and protect our margin. And it really was evident in the third quarter. If you looked year over year, our margins, our EBITDA margins stayed flat at about 20%. So, for us right now, we're not taking any margin hit. We're trying to push through appropriate price increases to manage through the inflationary impacts that we're, finding on a day-to-day basis coming, at us.
Do you think you're going to be able to sustain that? Do you think the consumer is going to continue, Elias, to be prepared to pay the higher prices? The evidence in the retail sales number this week is they are at this stage. You look at all the retailers reporting as well, similar narrative. But does that continue?
Yeah, and I think, Guy, it is, we saw that yesterday's retail sales number up 1.7%, incredibly strong. I think some of that has some inflation built into it, so I don't think the units were actually up quite as much as a result of that. But there's been a lot of ability to pass through pricing. We've seen the elasticity of demand be, pretty much inelastic right now. And so, part of what we're trying to do is manage for the long term. We're guarding against raising prices prices too high. It really is more a function of how do we protect margins right now without raising prices too much and hurting long-term demand creation. And so I think there's probably additional pricing that's going to be coming. We saw import prices rise quite rapidly. I think those are continuing to increase as we go forward. You know, we know of the supply chain problems. I mean, the whole shipping complex, whether it be getting, you know, cargo ships and containers to come over, getting it out of the ports, getting it onto trucks, every part of that complex is compromised right now.
Yeah.
And so I think these inflationary problems are probably more long-lasting than people anticipate.
And sort of the elephant in the room is also labor. Whether or not the supply chain issues get fixed in 18 months or 6 months is one thing, but with labor, you're not going to raise wages and then take that away. And I'm wondering, on the ground, what does that look like?
Yeah, Alex, labor has been one of our biggest challenges, and we've had more open positions this year than we've ever had in the history of our company. And it creates a lot of expense problems. We have to work people overtime. That's very expensive. You have more returns. You just don't fulfill as much of the demand as you'd like to. So we continue to increase wages in order to bring more people in, give spot bonuses to get people in. Now, I will say some of the labor availability issues are starting to relieve on a very minor basis in the last, I would say, 30 days or so. And I think that's part of a function of schools are reopening so people can come back into the workforce. We're finding that, you know, as the government transfer payments have been reduced from the pandemic era, that people are coming back into the workforce. But it remains a large challenge. And you see, you know, 10 million plus open jobs continuing month to month. We're seeing that on the ground. And, you know, when people say this inflation is transitory, you know, wages make up the vast majority of, you know, the cost of what comes out. And I think that, you know, I've never seen people want to take lower pay. And so I think they're more sticky than what is being anticipated. And I think we're all going to live with just a higher level of wages going forward. And that will have to feed through to consumer prices, whether now or eventually. And I think some of the big retailers that have held off eventually will have to raise prices in order to recoup some of their margin.
Elias, are you seeing inflation when it comes to asset prices as well? Like, clearly you are. We spent the whole show talking about some of the crazy valuations that are out there. In terms of the kinds of companies that you're looking at, what do you think?
Yeah, Guy, this year has been the highest asset prices we've seen since I've been doing this starting in '98. So, you know, over the last 23 years. It is really incredible. You know, if you think about it, there's been just a tsunami of money that's been printed by central banks globally. You know, everyone talks about how the Federal Reserve is changing course, but we have 6+% inflation and the Federal Reserve is still printing, you know, $100 billion monthly. And we're only talking about tapering. We're not talking about eliminating that, you know, altogether. All that money has to go somewhere. And when we have, you know, a negative real interest rate today that's 4.5%, it just pushes people out the risk curve. So we're finding more and more competition for private assets that we generally are looking to acquire. And the asset pricing has gone, you know, really hyperbolic, you know, over the course of this year.
It's fascinating to watch. Must be an interesting exercise, but a nerve-wracking one as well. Elias, great to catch up. Always appreciate your time joining us on the show. Elias Sabo, Coty CEO, thank you very much indeed. This is Bloomberg.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies?
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
For us, it's a question of how do we, as rapidly as possible, transition ourselves away from a fossil fuel-based economy. And that, of course, has a huge focus on the transportation products, but it also includes energy products.
All right, we're about an hour and a half into trading here in the U.S. One thing I wanted to highlight was Bitcoin falling by $850. It's testing that 50-day moving average, a super key level here. I mean, talk about the animal spirits. It feels like they're shifting out of Bitcoin and going to Lucid. I mean, is that something that's happening? UBS group chairman is sort of warning on crypto today as well as Bloomberg NEF. Guy, what are you looking at?
I'm looking at the European close. We're, 33 minutes away from that, 34 minutes away from that. We're going to count you down to it over the next 30 minutes, give you an idea of what's going on. There's a bunch of stocks that I want to focus on. The story about Lucid, the comparisons between Rivian and Volkswagen. We're going to talk much more about that. VW bouncing back a little bit today, up 0.4%. We were talking about that Biogen story relating to the Alzheimer's problems that they're having with their new therapeutics. That's rippling into some of the smaller biotechs here in Europe. BioArctic is one of those. That stock is down by 2.4%. And then there's Evolution. This is a Scandinavian gaming company. It's in the digital space. We are watching very carefully what is happening here because there's been some accusations that it's been involved in areas of the market it shouldn't be, some illegal betting. That stock getting knocked pretty hard, down by 4.88%. At a headline level, European equities are a little flatter. We'll talk about all of that very shortly. The close is next. This is Bloomberg.
Esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Wednesday the 17th, 30 minutes to the European close. This is what we're looking at. Stock 600 higher. We're at 490. We've taken out that key level. Mining stocks, also stocks, leading the charge. It's an interesting day. We're going to talk much more about it. As I say, 30 minutes to the close. We're going to count you down. This is Bloomberg.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So just under 30 minutes to go until the European equity market close. We're going to count you down into that close. This is the picture we're seeing right now. Underperformance coming through from the London market, but the pound is on the front foot as a result of the inflation data we've seen out of the UK today. We'll talk much more about that in just a moment. On the continent, it's much more of a flatter session, but remember that we've been accelerating over the last few days. Last week into this week, very positive. Maybe some just digestion happening here for European equities. As I say, the CAC 40 is up by 0.1%. The DAX is up by 0.1%. London is definitely the laggard. But as I say as well, Alex, miners on the front foot today.
Yeah, here in the U.S., it's sort of the fundamentals versus the exuberance. That's how I'm looking at it. The consumer discretionary, really the only sector up in the S&P, up by 1%, really helped by TJX, now up by 8%. Super solid numbers coming in, particularly that home goods segment. Overall, though, the market's a little bit mushy. The Dow is the biggest loser. Goldman Sachs weighing down by about 2 percentage points on the Dow. Target also trading heavy. Numbers solid. Sales okay. It was the margin story again, very similar to what we saw to Walmart. So that's kind of the fundamental read on where we are in the market. And then the exuberance comes with Lucid. Yeah, okay, stock is down by 3%, but had a very strong run pre-market, very strong run the last couple days, and now at one point was worth more than GM, worth more than Ford, $91 billion. That's where that speculative money is going. It was a favorite today, Guy, on Stock Twits. So clearly the retail investors are there. The boards are moving the market. Fundamental, exuberance.
It's amazing, isn't it, to watch what is happening here. And plenty of people are getting worried about what is happening. But are we 97? Are we 98? Are we 99? Certainly doesn't feel like 2000 just yet. But the build up to it, just maybe. Talking of things that are inflating, UK inflation climbing faster than expected. In fact, it's risen today in terms of the data we've seen to the highest level in a decade. That, of course, increases pressure on the Bank of England to hike interest rates. Maybe they bottled it last time around. Maybe December they won't have a choice. Lizzie Burden, Bloomberg UK economy reporter, joining us now. What is driving this inflation?
Well, you had a higher than expected contribution from restaurants and hotels, but mainly it comes back to energy. There were rising costs from wholesale, and that translated into higher natural gas and electricity prices. And remember, the regulator, Ofgem, allowed suppliers to hike tariffs to offset those rising wholesale costs, and you'll get another rise in April at the same time as a planned tax rise. So if the Bank of England doesn't step in soon, then this squeeze on household finances could choke off or at least undermine the recovery.
Well, Lizzie, what can the BOE, though, do about that? They can't actually create more natural gas, and they certainly can't change government policy in terms of the payroll tax.
No, and they can't help the shortage of truck drivers, as the Governor Andrew Bailey has pointed out. But they could ease the pressure on UK consumers heading into the winter. But at the same time, if they hike interest rates, then you'll get an effect on house prices. And so it's an interesting question to ask whether people will be asking for pay rises and whether that will feed back into the inflation. At the moment, from survey data, you're seeing it in starting salaries, but not not pay bumps for existing staff.
How many of the boxes are now ticked for the Bank of England to hike? We saw the furlough scheme details yesterday in terms of the employment numbers we got. That struck me as being kind of box ticked. We're moving on. I know we're going to get some more data before the next decision. Now we've got this inflation data coming through as well. What else could we need to see for the Bank of England to be convinced, the MPC to be convinced to hike rates?
Well, that's exactly what markets will be asking. What more could you need?
Yep.
And there is such an emphasis on the labour market from the Governor, Andrew Bailey, especially this week. He said it's the missing puzzle, the missing piece in the puzzle. You've had that strong labour market data yesterday. You've got more jobs data just before, on the eve of the decision. We'll get retail sales on Friday, so we could see what's happening to consumer spending. But it's difficult to see what else when the case is already so strong.
What are money markets pricing in at this point? Yesterday was 100 basis points by the end of 2022 in terms of hikes. What do they have right now?
It's about that, and economists, interestingly, are on board with markets. Before the November interest rate decision, there was a split between markets and economists, but economists are on board this time. They're seeing this rise to 0.25% in December as well.
All right, Lizzie, thanks a lot. Really appreciate the breakdown. Really interesting numbers coming out there. Bloomberg's Lizzie Burden joining us there. And just to recap that, so inflation's super high, but what's interesting is that a third of the things that UK consumers actually buy is now running at 5% or more a year. Olive oil, cigars, movie tickets, 30% of a shopping basket if you go to the store. All of that growing over 5%. Guy, what are you going to do?
These are the important things in my life. So what was that
Olive oil
list?
and cigars.
Sounds like a heck of a weekend. With a movie theatre thrown in as well. The real question as well is, do we find ourselves in a situation where actually there is a danger that the UK economy starts slowing? It is obviously fighting off all of these pressures and having to deal with that. And you wonder whether or not actually the Bank of England is trying to actually ask itself a question about slowing growth as much as inflation at the moment. Now, clearly the mandate is on inflation, but it's got to watch the growth story very carefully. Neville Hill, Credit Suisse Chief European Economist, joining me now on set. Where do you see the debate at the moment? We have clearly an inflation problem here in the UK that is growing. The data support that, and we're likely to get more of it. But there's also a growth concern as well that is increasingly being talked about at the moment.
I think they're married in a way. I think that's part of the problem that the Bank of England are facing, which is that, unlike other economies, the UK has had a really serious supply shock in the past year as a consequence of Brexit taking place at the same time as the pandemic. And I think that has meant that the trade-off between GDP or unemployment and inflation in the UK has really deteriorated. So in some sense, I think the issue the Bank of England are grappling with here is that the level of unemployment that we end up with after the furlough scheme has settled down might be too low for the economy to cope with keeping inflation at a 2% target. So in some sense, and the Bank of England probably wouldn't want to articulate it like this, the solution to high inflation might be slower growth, which looks as if we're going to get in the UK.
Well, we could probably get that without a rate hike. So rate hike, yes or no? How much?
Well, we're looking for a 15 basis point hike in December, and we're looking for rates to get up to 0.75% by the end of next year. So probably not as aggressive as the market is expecting, but probably enough to take some of the steam out of the economy, and in particular, I guess, some of the more interest rate sensitive parts of it, such as housing.
Neville, stay right there. We need to carry on the conversation. Neville Hill of Credit Suisse is going to be sticking with us. We're going to be talking about what the risks are when it comes to the euro area's financial stability. Warnings about housing markets overheating, warning about financial markets as well within today's stability report. We'll focus on that next. This is Bloomberg. think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the US, New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation is going to be transitory. Inflation, will slow down quite clearly. Perhaps the question is the intensity and how rapid, this climb is going to take place. And this is going to be related to the evolution of the bottlenecks, to the evolution of the cost of energy, and how persistent this is going to be.
ECB Vice President Luis de Guindos talking about inflation a little bit earlier on. Still with us, Neville Hill, Credit Suisse Chief European Economist. How different do the inflation pictures look like here in the UK, in the United States, which seem a little bit more comparable at the moment versus what is happening within the Eurozone? Yeah,
I think the Eurozone's looking pretty resilient at the moment. The inflation has gone up. Part of that's base effects. But you can, looking at it, you can really decompose what's driven inflation up by a lot of these transitory factors that should abate over time. So I think, the risks to inflation in the Eurozone are just far less considerable. One other really important difference between, I think, the Euro area and the US and the UK is that the labour market just doesn't seem to be anything like as tight. I think part of that is that the furlough scheme's done a very, very, very good job of keeping workers attached to their jobs. So you're not getting the kind of mismatch that perhaps you're getting in the US at the moment. But also, unemployment's 7.5% compared to 4.5% in the US or UK. So there does seem to be a lot more slack. So those wage pressures that we're starting to see emerge in the UK and in the US just don't seem to be a clear and present danger for the ECB.
Neville, I have a hard time understanding if that is a good or bad thing. So the way you just phrased it seemed like a good thing. But then I can read other economist notes that talk about how the fact that we did have so many people on unemployment actually led companies that survived be much more productive, and that we're going to get into some kind of CapEx cycle because of it, and we're not going to see that to the same extent over in Europe. What's the upside?
I guess the upside is that the economy does have more room to grow in terms of delivering lower unemployment over several years. So I think euro area unemployment could easily fall another percentage point or two below where it was before the pandemic, which was just above 7%. So as far as the ECB is concerned, it's got room for the central bank to keep its foot firmly on the accelerator. And I think this time round we've also got the capacity for fiscal policy to do more to support demand and the recovery over time. So I think it's a high-quality problem. It is a problem. You'd rather unemployment was lower and as low as it needs to be. And that's been the challenge the ECB was grappling with before the pandemic. And I think it's going to have to continue to deal with that in the years to come.
What are you anticipating on the fiscal front? The Greek Prime Minister was here yesterday. He was pretty confident that the Growth and Stability Pact would be significantly altered. It will have to be if Greece is going to in any way get close to the targets that may or may not be set. What are you anticipating there? Do you think the fiscal impulse will continue in Europe next year, or do you think the hawks may ultimately step in and make it harder, particularly for some of those peripheral countries?
I think the rules will be eased in a way that they're not as restrictive as they were in the past decade. And I think Europe's done a very good job of learning from its mistakes that it made in the 2010s in terms of excessively tight fiscal policy and not managing recessions well. So I think, we won't have that pressure on governments to reduce debt quickly. We won't have the pressure on governments to consolidate their public finances, get the deficit back below 3% in as much of a hurry, which will allow for, I guess, a less restrictive fiscal policy stance. The other big missing part of the jigsaw here is the scope for, I guess, federal fiscal policy to take some of the weight this time round. And, with the moment we've got the recovery fund starting to disperse money, that's going to really start having a positive impact on euro area growth next year. And the big question for me is, once we've got a new German government in place, once we've got the French elections out of the way next year, is there room, scope for, France, Germany and Italy to turn the recovery fund from a temporary problem or a temporary fix into a more permanent fiscal policy for Europe that will ultimately allow for a federal fiscal response in future that would really help underpin economic growth.
Is Germany really on board with that? I mean, you talk about how there's much more fiscal flexibility and not sort of that budget cap. Is Germany really going to go that way?
I think the prospective coalition in Germany certainly seems to be much more inclined in that direction. Both the SPD and the Greens are keen to make the recovery fund a permanent fiscal mechanism, and both parties clearly have some ambition in terms of boosting German public investment, particularly in green direction. It's true their other coalition partner, the FDP, are less enthusiastic about both of those, and it strikes me in terms of the agreement we've seen so far that the FDP are probably more keen on fiscal restriction and orthodoxy at home than they are opposing a European fiscal development. So it may well be that the national fiscal rules still remain fairly strict in the long term. You've got to have a deficit below 3% of GDP, but there is scope for, as I say, a federal fiscal authority over time to take some of the burden of fiscal stimulus away from national governments to, I guess, a pan-euro area facility.
We spent a lot of the last hour talking about Volkswagen versus Rivian, the fact that you've got these stocks that are taking off in the United States, that people are concerned that we're heading for a kind of 2000-style bubble and then a burst. We had the financial stability report out today. We've got an idea of kind of how the authorities in the Eurozone see risk at the moment. It feels like we're on different pages. There are bubbles, there's housing market issues, and obviously the financial markets are enthralled to the central bank. But it doesn't feel like it's in any way the same sort of explosion in risk-taking that we've seen on the other side of the Atlantic.
No, I think that's right. And I think the ECB, in a financial stability review, you've always got to sound worried about exuberance somewhere in the economy, and they flagged up, credit markets, they flagged up real estate. But actually, what was really notable for me in the financial stability review was, what wasn't in it in terms of what they were worried about. And actually, a lot of the sort of details in the document about the performance of bank assets and in particular non-performing loans, it's really striking that, if you turn the clock back 12 or 18 months, that's exactly what we'd be worried about coming out of the pandemic. And instead, the quality of bank assets, the quality of loans, the quality of corporate and household balance sheets is remarkably good. And I think that really does help underpin a solid recovery, because you don't have the kind of economic scarring either in the real economy or the financial system that, as we saw a decade ago, really impeded the pace of economic recovery. So I think that's encouraging.
Neville, it really feels like you're quite positive on the European economy, especially, say, versus the U.S. I mean, is that a fair statement to make? And I say that with surprise, because we're still weighing like $2 trillion bill in the U.S. I mean, talk about some serious stimulus. And we just keep getting inflows, particularly from retail investors that's just propping up stocks.
I think the prospects for Europe certainly look good relative to how they've looked, coming out of past recessions, and particularly in 2010, but also actually, in the aftermath of the dot-com crash. So I think, the economic infrastructure and I think, the policy response that we had during the recession really do help underwrite a much better and more vigorous recovery over the next few years than we've been used to. And I think that will surprise investors. I also think, another sort of relatively optimistic glimpse at Europe at the moment is the fact that if we are talking about imposing things like higher carbon prices, shifting towards a green transition, the European economy is relatively well positioned for that. I wouldn't say it's brilliantly positioned, but it already has high carbon taxes. It already has a fairly low carbon intensity of production. So there are sort of, I guess, glimmers of optimism that you might be able to pick out of Europe that, if you were looking at the Eurozone, 5 or 10 years ago, you'd be very hard pressed to find.
No, fair enough. All right, Neville, thanks a lot. Neville Hill, Credit Suisse Chief European Economist. Thank you very much for joining us here. All right, coming up is Visa is not everywhere that you want to be in the UK anyway. Amazon says beginning next year it won't accept Visa credit cards issued in the UK. Visa's down by about 75 points here in the US, really weighing on the Dow. We'll break down what this all means. This is Bloomberg.
Finally got your taste of MIT. So why did you decide to leave MIT and come in and run the SEC?
One, when a president asks you to do something, it's really hard to say no. But it's also just an incredible privilege and an honor to serve.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Lagging profitability that the European banks still undoubtedly have is structural weaknesses, which are linked to cost efficiency, to focus on business model, to investments in digitalization.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. UBS Chairman Axel Weber has issued one of his strongest warnings yet on cryptocurrencies. Weber spoke at the Bloomberg New Economy Forum in Singapore. He said he is skeptical of digital currencies and that the concept of anonymous payments won't last. Weber is a former central banker who has been bearish on crypto for years. And Amazon is making another attempt to push back against fees charged by payment networks. Starting next year, the world's largest online retailer will no longer accept purchases made with Visa cards issued in the UK. Amazon says card fees are an obstacle for businesses trying to get the best prices for customers. Visa says it's disappointed and is trying to resolve the problem. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. Just to be clear, it's Visa credit cards that we seem to have an issue with. Well, no, it's debit cards are fine. So credit cards problem, debit cards are fine. I'm just kind of clarifying what is happening here. But Alex, this feels like a warm-up. This feels like a warm-up to a much bigger fight. So I'm wondering where this is going, because they've been having issues with Visa in Singapore, Australia. Now we're into the UK. what's next? Charlie Wells is here from Bloomberg News to help us kind of break this all down. What do I make of this? What is going on here? This feels like a kind of preliminary skirmish, part of the preliminary skirmish between these two companies.
Guy, you are right. So this is sort of corporate brinkmanship. This is two of the biggest players in e-commerce literally looking at themselves in the eye and saying, I dare you. And today, Amazon did, right? They are betting that their customers here in the UK will stick with them, even if they are told that at that purchase point, they need to change cards. That's a bet, but that's a bet they were willing to make.
So then, in terms of Visa, what happens next? Because this is really only like, what, 2.6% of their total. So in and of itself, it's something that Visa can very well manage. How does this sort of snowball?
Yeah, Alex, that's a really good point. And look, we're seeing Visa shares down now to the lowest level since February. Of course, this is a very UK story, as Guy was saying. The day is young. What we do know is that Visa had been planning on a major change to its interchange rate in the United States, where, of course, it is also an incredibly popular card. That was supposed to come into effect in 2020, but it was postponed until April of 2022. So we could potentially looking at a much bigger battle looming in the months ahead.
So this is a warning shot.
I would say it's a
because they use MasterCard over here for their Amazon use MasterCard for their cards, but they use Visa in the States. So this is a warning shot.
This is a warning shot, and Amazon has been trying for a really long time to cut out some of these card issuers, right? We've seen them try to have people link up their bank accounts to make payments. They've tried to push debit cards, which are of course cheaper, but I'm not sure if this is going to work.
Is there anyone else, any other company, like credit card company, debit card company that is on the chopping block for this, or is this a Visa, Amazon specific UK thing?
This is really interesting because, I mean, usually here in the UK, when you are making a purchase, say on a travel website or some, sort of smaller company websites, you see it's actually Amex that the company doesn't accept. And so this is really interesting, and it sort of reflects a change in the card market in that some of these larger issuers, the Visas in particular, are rolling out these premium cards, and they're expensive, right? Someone's got to pay, and what we're seeing is it's retailers.
It's a massive issue when you've got an Amex corporate credit card. Trying to use it in Europe?
Good luck.
Precisely. Good luck. It's a huge problem, Alex. You go anywhere and they're just like, no, we'll take the Visa. We're not going to take the Amex. Obviously a different situation over in the States. Charlie, great story. Thank you very much indeed, Charlie Wells. But it's going to be interesting. Maybe next year things start to change. European equity markets are about to close. We're about, 4 minutes away till the end of the day here in Europe. These are the numbers. The FTSE 100 is certainly being dragged down. The miners are actually on the front foot, but there's a pound factor in all of this. The inflation number we were talking about a little bit earlier on means that the pound is up. There's a kind of translation effect that you see that therefore hits the FTSE 100. DAX and CAC, they're not doing anything. They're absolutely flat. We're going to talk more about that next. The close is coming up. This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm on.
I noticed that.
Do you think I need a lift? Is it time
what
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
So we're counting you down into the close here in Europe, the end of regular trading about to happen. We're kind of falling into the close as well. We're certainly softening up in the London market. You're seeing it elsewhere. The CAC and the DAX over the last couple of minutes certainly softening up. So we're near session lows. Volume's pretty much average, so there's nothing really to take away from that. The FTSE 100 certainly suffering more than most. There's a pound factor. So you had a strengthening of the pound today versus the euro on the back of the inflation data we saw a little bit earlier on. The speculation, of course, is that the Bank of England, given the data we've seen over the last couple of days, are going to pull the trigger maybe a little bit earlier. And as a result, the pound strengthens on the back of that, not against the dollar, but against the euro. On the continent, the DAX is flat, the CAC Eurant is absolutely flat as well. Feels like we're just kind of pausing a little bit, a bit of digestion after the recent rally that we've seen in European equities. This is how the session has developed. As I say, a little bit of a fade into the close here in Europe. Not much of one. We're just coming off, as you can see. But nevertheless, we are at 490 on the Stock 600. We're up by less than sort of 0.2%, but they are gains, and we continue to make those gains. So we're pushing through the 490 level here in Europe. Feels like we're going sideways right now, but kind of that's been the story over the last few days. Kind of you've seen this kind of pick up. It's been very incremental, but it's happened day by day. In terms of the message that we're managing from a sector point of view, the miners have definitely been on the front foot today. Technology, the car sector has been picking up as well. We're going to talk much more about the car sector in just a moment. Where's the weakness? Travel and leisure. It's actually the leisure rather than the travel that is causing the concern there. Real estate coming down as well. We're starting to see some of the UK listed property companies reporting numbers. Generally, the picture actually is that companies are taking out huge amounts of space in London. They've got to bring people back into the office and they've got to separate them. That is actually causing something of a pickup, not reflected in the numbers today. So let's talk about some of the individual names and figure out what is happening here. Evolution is a gaming company. It has been accused. It's a slightly perplexing story. It's been accused by a rival's lawyer about the fact that it's been doing business in areas that are under US sanctions. I think people are struggling to kind of get to the bottom of actually what is happening here, but as ever, you kind of shoot first and ask questions later, and as a result of which Evolution is trading down. We talked about the Biogen story. There's pushback from European regulators in terms of its Alzheimer's, its new Alzheimer's drug. That's rippling through into other areas, smaller biotech companies here in Europe that are in the same place. BioArctic's one of those. It's just softening up a little bit. But after all of the focus on Rivian over the last few days and the fact that it's now worth more than Volkswagen, today Volkswagen bounces. It's not up by much, but remember, it's a big stock. It's up by 0.6%, Alex.
All right, let's stay with autos for a second. So on the one hand, you have Volkswagen. Like you mentioned, it's up a little bit, but it was cut by Exane BNP Paribas after the close yesterday to underperform because the competition in the EV space is just really tough. Now, pair that with Rivian, for example. Sure, Rivian stock is down today, 14%. That's nothing to sneeze at here, but the valuation of this company is still $132 billion. You also have Lucid in the U.S. being worth more than GM and Ford. So what's going on here? Arndt Hellinghorst, Bernstein and Global Automotive Research Head, joins us now. Arndt, when you look at these things, is it fundamental? Is it animal spirits? Is this 2000?
Look, it's not fundamental at the moment, but it's obviously the clear reflection that we're moving in a new era of automotive technology, that software and electric, powertrains will become substantially more important. And in these areas, the startups have several advantages. Whether that justifies the valuation that you've just talked about is a completely different question. But the train has left the station. We're moving into, connected digital electric mobility. The only point, and that's what we discuss here as well, is how will these traditional OEMs manage the transition, and how relevant will they be in the future? Or will the entire market be taken up by, the Rivians, the Teslas, the Lucids, the Japanese EVs? Because that's what current valuations suggest.
Are the current valuations wrong, Arndt?
I think they are wrong. I think they don't reflect the economic opportunity. Because I do think that even if we discount huge mega growth, that these companies occupy the lion's share of car sales in the future, a reality is also that they will converge to fairly normal auto companies. And even if they can generate margins like a Porsche, right? And that's highly questionable, even then those valuations are too high.
So if I wanted to play the shift into EVs and not be saddled with like a legacy company that still has its traditional business that it's dealing with, how do I do that and manage the kind of volatility?
Well, you have various options, right? I mean, you can look at various suppliers. A company like Aptiv in the US has done phenomenally well. You can look at other parts of the value chain. You can think about battery makers. And look, if you don't want to be engaged with the legacy because you think it's such a bad thing to generate free cash flow with, hybrid vehicles, whether it's a Toyota or, even internal combustion engine vehicles, if you think about a BMW. If you don't want to do that, there's even cheaper electric vehicle exposure in China than, the Lucids or the Rivians right now.
Arndt, VW makes what, 10 million vehicles a year? Who's going to make 10 million? If it's not VW making 10 million vehicles a year, who's going to make 10 million vehicles a year?
I just really don't know. I think the future will be that, Toyota will make 10 million vehicles a year. Maybe one day Tesla will make 10 million vehicles a year because they have a global brand and they have the ambition to sell as many EVs as they can. And they're ramping in China, in Europe, in the US. It's just a very, very long journey, because what people always forget is manufacturing an electric vehicle is as complex and complicated. It needs a lot of CapEx, investment in tools, paint shop, robots. It's not that different from manufacturing an internal combustion engine vehicle. Despite all the stuff that's being made up out there, it's still, pressing a lot of steel into a chassis and assembling everything, painting everything, making sure the quality is automotive grade. So if you walk through an EV plant, it looks, feels, smells very similar to a combustion engine plant.
Well, that's really interesting, because what I was going to ask you is the struggle with these traditional automakers reminds me very much of what's happening with energy companies. And Dan Loeb is pushing for Shell to sort of to break up, right? Spin off its sort of alternative business and then leave its traditional oil business over there. Are we seeing any calls for that for the traditional automakers?
Yes, we are having these type of discussions with traditional OEMs. At what point does it make sense to move your legacy business, your cash cow, into a separate business and free up the valuation for your future mobility asset? It's an increasing discussion, and it's obvious, right? If you look at these valuations out there, there is an opportunity. And car makers have started outsourcing engine portfolios to suppliers, outsourcing engine portfolios into joint venture. So I think that's a journey, and it's a discussion that the shareholders will lead with all car makers in the coming years.
Did Herbert Diess overplay his hand when he started to act like Elon Musk earlier on this year?
I think VW and Herbert Diess were very aggressive in pitching the whole narrative of we will be the largest EV maker. We will be, we'll turn ourselves into a software company. The narrative is correct in terms of a wake-up call for the company. I think that really helped them to transition fast and to commit, especially after the diesel crisis. I think VW now really needs to focus on execution. They need to get the ramp up of their EV fleet. The curve needs to steepen substantially. They need to fix some quality issues, and the market is now really expecting execution and less talk.
Arndt, it's always a pleasure. Greatly appreciated. Thank you very much indeed for your time today. Arndt Ellinghorst, Bernstein Global Automotive Research Head. Final numbers here in Europe. This is what they look like. In some ways, a fairly tepid session for European equities. Few standout stocks that are worth focusing on, but the FTSE 100 dipping into the close a little bit. The DAX and the CAC, though, just managing to hold on to positive territory. Volume wasn't great, but the Stock 600, you can see the gains. We made 490 today. I appreciate we had a touch through that yesterday. We've held on to it today. The gains are just kind of inch by inch at the moment, centimetre by centimetre, but we continue to climb a little bit higher, Alex.
Yeah, it's a mixed picture. Definitely, though, here in the U.S., the Dow really trading kind of heavy, down by 0.5%. Coming up, we're going to talk about Alphabet. It was the latest to join the $2 trillion market cap. We're slightly below that level now, but nonetheless, they're part of that club. What's going to drive the next $1 trillion worth of growth? We're going to hear from Sundar Pichai, Alphabet's CEO, coming up next. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I was just finishing what you were saying, Tom. November 3rd, when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
it's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
For fuel, restaurants and hotels led the jump in prices. China's Vice President Wang Qishan is calling for the rest of the world to promote trade and investment liberalization. He also said China would contribute to an open world economy. Wang spoke at the Bloomberg New Economy Forum over in Singapore.
China cannot develop in isolation of the world, and nor can the world develop without China. China will not waver in its resolve to deepen reform and expand opening up.
Wang said that China's leader Xi Jinping and President Biden had reached important understandings in this week's virtual summit. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So Alphabet just recently hit that $2 trillion market cap. So where are you going to get that next $1 trillion worth of growth? Well, Bloomberg technology host Emily Chang sat down with Alphabet CEO Sundar Pichai for the Bloomberg New Economy Forum, and they talked about the aftermath of the Facebook controversies and whether the search giant will have a role in the metaverse.
We've been on as a company, we are trying to do more with less data. One of the biggest changes we made was making auto-delete the default setting for new users signing in, and now over 2 billion users have their data continuously being deleted. Look, we rely on trust for people. Every day when people come to Google, they place their trust in us in vulnerable moments. It may be a health issue on which they are trying to understand. There's no more important responsibility we have than doing right by that trust. When we provide Gmail to journalists and realize that their accounts may be under attack by an authoritarian government, that's what motivates us to make sure, be it privacy, be it security, be it trust, we are doing the right thing. Over time, regulation will have an important role to play here. I think privacy regulation is important. In areas like AI, regulation will be important. And so I think, those will be part of the answers as well.
Facebook and Microsoft are all in on the metaverse. You think about the